Hi, everyone, and welcome to this Wealth Management Fast Chat. My name is David Armstrong. I'm the editorial director at wealthmanagement.com. Today, I'm thrilled to be joined by Nisha Patel, who is the managing director and lead fixed income portfolio manager for Parametric. Nisha, thanks very much for joining us.
Thanks for having me.
So we know that there's some potential tax law changes on the horizon. What do you see out there? And given that, what sort of asset classes become more attractive to you?
Sure. So, look, I think the asset class that we really like right now for really three main reasons is municipal bonds. The first reason is that we have a very supportive environment for bonds in general, especially as the Fed just went through with a first rate cut of 50 basis points last week, the first after 4 years. And their new dot plot is also showing further easing of close to about 125 to 150 basis points of further easing by year end. So what this means is that this should be a supportive environment for bonds as yields could continue to trend downwards and bonds could appreciate in price. The second reason that we really like municipal bonds is, as we have seen generally yields trend downwards for most fixed income asset classes, municipal bond yields as of now have actually gone up year to date. And the main reason for that is that we've been seeing a lot of supply in the market as a result of many issuers moving up their deals prior to election time, where there's anticipated volatility. And that's not atypical of most normal election years, if you will. So that heavy supply relative to the demand of the market has really created an imbalance and really weakening a little bit of weakness and higher yields in municipal bonds, thereby providing a really great entry point in our view. The third reason that we really like municipal bonds as an asset class is due to, the anticipated tax changes. I think that, with the Tax Cuts and Jobs Act likely expiring, or at least it becoming very difficult to extend further tax cuts, the reality for most high net worth individuals is that tax rates have a likelihood of going up from here, which means that tax exemption value that tax exempt munis provide should only increase from here onwards and make for a valuable allocation in their portfolios.
So given the likelihood of higher taxes, the falling interest rate environment, what are some strategies that advisors and high net worth clients can take now?
Sure. So, look, I don't think volatility is gone by any means, right? I mean, I think that we could continue to see some more volatility just as a function of market reactions, obviously as the Fed cuts, but the direction and the path of those rate cuts over what period of time. And the third is just elections, right? I mean, you could have just market volatility around election time and certainly right after the outcome of it. So in short, my point being is that I think active management is going to really be valuable in clients' portfolios. So, in, let's say, an asset class like municipal bonds, we have a total return strategy that allows you to do various things to optimize for total return for clients. That could be yield curve positioning, that could be advantageous and opportunistic trading in the market, and incorporating ongoing tax loss harvesting in client portfolios. The last strategy that I will mention, and again, in light of potential tax law changes, look, the reality is that there's more and more focus on tax efficiency overall in client portfolios, especially when it comes to separately managed accounts. So this new strategy that we recently launched called Tax Optimized Ladders allows clients to optimize across investment grade asset classes like municipal bonds, corporate bonds, and treasuries to optimize in the best after-tax yield outcome based upon individual tax rates, right? Based upon individual federal and state level tax brackets. So, again, with the potential tax changes, this strategy really allows that true customization and elevating a form of tax rates in this strategy, which I think will be increasingly valuable in the coming years.
You mentioned tax loss harvesting. Explain the potential benefits of tax loss harvesting.
Of course. So reason that we've seen such a massive shift into separately managed accounts, also known as SMAs, and particularly in fixed income, is really due to the tax efficiency that SMAs can provide relative to, let's say, ETFs or mutual funds. And one process that our team at Parametric is leveraging is tax loss harvesting on an ongoing basis. And this is something that can be impactful and a unique differentiator for many of our clients that are leveraging this, and especially as we're taking advantage of it when the opportunity exists. And, in a market like, let's say, taking it back to municipal bonds, it's really made sense to tax loss harvest at the end of the year. That's as a result of less replacement options, not as much issuance, poor liquidity. And so if you look back, the past 20, 30 years, it's really made sense actually in that last quarter. It's made more sense to do it in the previous quarters, quarter one and quarter three. And so when we look to do this on a year-on basis, we can really look to optimize the value from a loss harvesting perspective. If you take a look at this chart, let's take a look at a year like 2023. And if you notice here in the chart in terms of where yields had peaked, you'll note that yields actually peaked closer to around kind of that October timeframe. And then towards the end of the year, we had yields actually plummet. And so if you had waited until the end of the year, again, you would have missed out on many of these opportunities. Not only were we able to lock in losses for our clients, we were also able to lock in higher book yields in their fixed income portfolios as well. And so as a total, we were able to trade roughly about $17 billion in market value, realize in aggregate about $510 million of total losses, and we took an average loss of about 4.75% across our holdings. And lastly, I'll just say this year also is looking to be like a similar example, right? Just in terms of where yields had peaked, we're headed into kind of towards the end of the year, our Q4 period. I would argue that if you hadn't already locked in many of these losses in client portfolios, you may have missed out on many of those opportunities. So again, this is just a very impactful and unique differentiator that we provide in our clients' fixed income portfolios.
Okay, that's fantastic. Nisha Patel, Managing Director and Lead Portfolio Manager for Fixed Income Investing at Parametric. Thanks very much for joining us.
Thank you.